My name is Claudia Koo. I am a chartered accountant with 20 years of experience helping business owners to take care of their taxes from all aspects. This includes implementing strategies to defer taxes to future years, or even better, to eliminate taxes altogether. To take the most beneficial filing positions in preparing all the tax returns as required and in a timely manner. To challenge the CRA on any tax audit or dispute. All my clients are very free with their taxes, whether for themselves and their family personally or for their corporations. If you are a business owner, I'm going to show you how you may be able to save $160,000 to $200,000 of taxes when you sell your business or transfer the business to your next generation. This tax saving strategy also works if the business owner was to pass away while owning the business. One of the tricks for this income tax saving strategy is that you, the business owner, may need to plan ahead before you have any conceivable ideas of selling your business. The tax saving strategy is to claim your $800,000 lifetime capital gains exemption. Sounds simple and straightforward, right? I will use a simple case study to illustrate some of the complexities in claiming the lifetime capital gains exemption, and my point why you, the business owner, may need to plan ahead before you have any conceivable ideas of selling your business. In this case study, Mr. J owns all the shares of a company called J Code that he established 3 years ago. He was approached by a potential buyer who offered to buy all his J Code shares for $800,000. Because Mr. J did not have any capital in J Code, he would realize a capital gains of $800,000 if he accepted the offer. How much tax would Mr. J have to pay? It depends whether Mr. J would be able to claim his lifetime capital gains exemption. Let's first look at the worst scenario. Mr. J lives in Ontario, and he has some other income that put him in the top marginal tax bracket of about 50%. That means for every extra dollar that Mr. J made, he needs to pay 50 cents to the government. Capital gains are taxable at 50%, so only half of the $800,000 capital gains, that is $400,000, would be taxed at 50%. If Mr. J was not able to claim his lifetime capital gain exemption, he would have a tax bill of about $200,000. In the other scenario, if Mr. J was able to claim his lifetime capital gains exemption, the exemption would wipe out all the gains and he would have no tax to pay. Which scenario would you like to be in? So how could Mr. J claim his lifetime capital gains exemption? He needs to meet 3 requirements. The first requirement is the J Code shares were not ever owned by anyone other than Mr. J himself or a related person in the past 24 months before the share sale. For example, if the J Code shares were acquired by Mr. J from an unrelated person a year ago, this requirement would not be met. The second and the third requirement are asset tests that applies to J Code. For the purposes of the asset test, the assets of J Code are categorized into 2 pools, good asset and bad asset. Assets used in the active business operations in Canada are good asset. Anything else are bad asset. This includes excess cash, portfolio investment, or real property that is not used in the Canadian active business operations. Assets used in the active business operation but in foreign countries are also bad. There are also complex rules that deal with shares or debt in related corporations. The asset test in the second requirement requires that at least 50% of J Code's assets in the 24 months period before the sale are good assets. This requirement would not be met if Jacob's asset were ever offside for any brief period in this 24 months duration. The other asset test in the third requirement requires that at least 90% of Jacob's assets at the time of sale are good assets. So the threshold for the good asset increased from 50% for the 24 months period before the sale to 90% at the time of the sale. As a recap, Mr. J needs to meet 3 requirements for claiming his $800,000 lifetime capital gains exemption in order to eliminate $200,000 of taxes on the sale of the Jacob shares. 2 of the 3 requirements applies to a 24 months period before the sale. I know it's a lot of information to take in, and I hope you are still with me. The key point for you, the business owner, to take away from this video is that you should engage in advanced planning for claiming your lifetime capital gains exemption. This can be part of an exit strategy to sell the company or part of an estate plan. You will be able to save $160,000 to $200,000 of taxes. The actual taxes varies depending on the province that you live in. I am Claudia Koo. I hope you find the information helpful. See you in the next video.